Okay, then we are looking at Chapter 2, and we're going to combine problems 10A, 11A, and 12A together because what we're doing is we're going to be performing the statements for J. Pembroke. So in 10A, just ask us based on 9A, what we did previously example, we're going to prepare these income statements. So what happens is we're going to be taking the information from 9A. The balances at the bottom, if you want to refer back to that, so for example, cash balance ended up being $12,950. So those are all the balances we're going to take and put them into the proper financial statements. So you can see the financial statements here, and we're going to look at each of them. The first statement you have to prepare is the income statement. You absolutely have to prepare the income statement first. So the income statement is going to state what our income is, whether we've made money or whether we've lost money. So in this situation, our revenue, our title revenue account was our service fees. Based on 9A, we earned $3,300 in revenue, or we provided $3,300 worth of service. The expenses, we only had one expense, and it was $750, so that goes here. Now, if we would have had like 2 or more expenses, we'd have added them in this first column, because this first column is for pre-calculations, and the last column is for final calculations. But because we only had one, we put it into the far right column. So our revenues minus our expenses gives us a net income, which means we made money of $2,250. If we would have lost money, say our rent expense was $3,500, we would have lost $200 and we would have had a net loss. So it's important that you find the net income before you go to the second statement, which is a statement of owner's equity. You can see that the green here filters down into the statement of owner's equity here for Ch. Pembroke. So the first thing we're going to do is we're going to start with the beginning capital balance, or the original investment of April 1st. April 1st is the beginning of the month, so therefore we know that is our beginning balance. And we invested $18,000 in the company to begin with. We're going to add in our net income that we calculated in the income statement, but we're going to do pre-calculations here because we have to subtract out any withdrawals. So although we made $2,550, Jay went in and took out $100 for personal use, which only left us with an increase in capital of $2,450. So we started with an investment of $18,000 through revenue minus the withdrawals. We increased that capital by $2,450, which gives us an ending, or an April 30th capital account balance of $20,450. One of the most common mistakes that I see is that in filtering this now onto the balance sheet, a lot of people try to take this beginning $18,000, but it has to be this ending. We have to take into account the net income and any withdrawals. So then the third statement over here is our balance sheet. Now on the balance sheet is just the accounting equation. You're going to have all assets equal, so total assets is going to equal total liabilities and owner's equity, just like the accounting equation, assets equals liabilities plus owner's equity. So these account balances are again taken from the end of 9A, if you want to refer back to that. And so we list all of our assets and get our total assets. We list our liability. We only have one account with $300, and then the orange designates that coming from the statement of owner's equity, we're bringing in the ending balance of our capital account, and when we add those together, you can see that my total assets equal my total liabilities.